If you bought gold above 5,000 or silver above 90, I'm not going to sit here and tell you everything is fine. It is not fine. Your money is down, maybe significantly. And that feeling in your stomach, that heaviness when you open your portfolio and see red everywhere, that is real. I know it. I feel it. And I'm not going to insult you by pretending it does not hurt. Gold went from 5,600 to 4,900. Silver went from 21 to 75 in some cases in days. These are not small numbers. And now every headline, every comment section, every financial guru is telling you the same thing. You were stupid. It was a bubble. You should have known better. Sell what is left before it gets worse. And that is exactly what I want to talk about today. Because I think those headlines, those gurus, those voices telling you to sell right now, I think they are wrong. And I think some of them know they are wrong. And I am going to show you why I believe that. But I am also going to be honest about the risks. Because anyone who tells you they know exactly where gold and silver are going next is lying to you. I do not know. Nobody knows. What I can do is show you what the data looks like right now and let you make your own decision. That is all this video is. Data context. In my honest opinion, take what is useful, leave the rest. Welcome to the SHF Money. If you're new here, hit subscribe. I have been covering this metal story for weeks, and I have not been wrong yet. That does not mean I will not be wrong eventually, but my track record is there for you to check. Every video is still up, and I want to tell you I have only one channel, which is the hidden economy. When silver was at $117 and everyone was celebrating and buying like nothing could go wrong. I made a video on this channel warning that a big crash could be coming. 117. I told you why the setup was dangerous, why the leverage was extreme, why the conditions were ripe for a violent pullback. People were calm. People were buying. Nobody wanted to hear it. And then silver went from 121 to 64 in days. Exactly what I warned about. I'm not saying this to brag. I am saying this so you understand that when I tell you something today, I have earned the right to be heard. I was not one of the people cheering at the top. I was the one telling you to be careful. And now I'm telling you something different. I'm telling you this crash is an opportunity. So maybe hear me out. And if you are sitting there right now, scared, not sure what to do, not sure who to trust, then join my channel right now, because this is what I do here. I break down gold and silver in a way that actually makes sense. No hype, no blind optimism, just data, context, and honest analysis. Every video I have made on this channel is still up for you to check. I hold silver, I hold gold, I hold mining stocks. This is not financial advice. This is me sharing what I am seeing and what I am doing with my own money. Now, let me tell you something. In 2008, gold crashed from over $1,000 to $680. 32% drop. Every headline said the same thing. Gold is done. Safe haven is dead. People sold. Within 3 years, gold was at $1,900. Think about what that feels like. Selling at $680 and watching it go to $1,900, then $2,000, then $3,000, then $5,000. You had it. You owned it. And you let someone scare you into giving it away. In 2020, at the start of COVID, silver crashed to $12. 12, people panicked and sold. Within 18 months, silver was at 30. The people who held at 12 are sitting on 600% gains right now because they did not sell. And now here we are again. Gold dropped 21% from its peak. Silver dropped 41%. The worst single day for silver since 1980. The same voices are saying the same things they said in 2008 and 2020. It is over. Sell. Move on. I'm not saying history has to repeat. Maybe this time is different. Maybe the crash continues. Maybe gold goes to 4,000. Maybe silver goes to 50. I cannot rule that out. And anyone who does is not being honest with you. But what I can tell you is that the last 2 times the world looked exactly like this. Selling was the worst decision you could make. And the reasons it was the worst decision then are the same reasons I think it might be the worst decision now. Let me show you what I mean. The first thing I want you to see is a chart that has nothing to do with gold or silver. It is a chart of the U.S. stock market going back 140 years, specifically something called the Shiller PE ratio. Do not worry about the name. All it measures is how expensive stocks are relative to what companies actually earn. The higher the number, the more overpriced stocks are. Right now, that number is 40, 58. In 140 years, it has only been higher than this twice. The first time was 1929. You know what happened next? The second time was 2000, right before the dot-com crash. Those are the only 2 times in your great-grandparents' lifetime that stocks were more expensive than they are today. Why does this matter for gold and silver? Because both times after stocks crashed from those extreme levels, money flooded into gold. After the dot-com crash, gold went 7 times higher. After 2008, gold nearly tripled. The pattern is simple. When stocks are this expensive, something eventually gives. And when it gives, people rush to the thing that has held value for thousands of years. I'm not telling you the stock market is about to crash tomorrow. I'm telling you that the environment, the setup, the conditions, they are identical to the two worst periods for stocks in modern history. And in that environment, gold and silver have historically been the best place to be, not the worst. And here's what makes this personal. You are worried about gold dropping from 5,600 to 4,900. But are you equally worried about a stock market that is more expensive than it was before the Great Depression? One of those is a correction in a bull market. The other is a potential generational collapse. Ask yourself which one the media wants you focused on and ask yourself why. The second thing I want you to see came out 3 days ago. Reuters, not some random blog. Reuters reported that Chinese regulators are telling their banks to reduce holdings of U.S. government bonds to limit new purchases to pare down positions. The reason? Concerns about U.S. creditworthiness. Let that land for a second. The second biggest economy on the planet does not trust American government debt anymore. And they are not hiding it. They are telling their banks to get out in public on the record. Where does that money go? When China sells billions in U.S. bonds, where does it end up? History tells us it goes into gold. China has been the biggest central bank gold buyer for years. And now they're accelerating. They're making it policy. While you and I are sitting here watching our gold portfolio go down and wondering if we made a mistake, China is actively moving its national reserves into the same asset class we own. Let that sit with you for a second. And this is not just about China. Trump's approach to trade, his pressure on the Federal Reserve, the tariff threats, all of it is making countries around the world nervous about holding U.S. assets. The Reuters article specifically mentions that market participants are questioning the haven status of U.S. debt. That is a quote, the haven status. When the world's safe haven asset starts losing its reputation, the replacement is not crypto. It is not stocks. It is gold. It has always been gold for 5,000 years. Now, let me show you something that genuinely changed how I think about money. Take gold priced in dollars and flip it. Instead of asking how many dollars does an ounce of gold cost, ask how much gold does $1 buy over the last 50 years. The dollar has lost 99% of its purchasing power against gold since 1970. There have been 4 brief rallies for the dollar against gold in 50 years. 4, each one weaker than the last. The chart looks like a staircase going into a basement, and the annotation says the target is 0. Is it going to 0 tomorrow? No, but the direction has not changed in 50 years. Not once. And every time the dollar has a good week and gold drops, people mistake a bounce on the staircase for a reversal of the trend. It never is. It has never been in 50 years. So when I see gold drop from 5,600 to 4,900 and people say the gold rally is over, I think about this chart. I think about 50 years of data showing the exact same pattern. Dollar rallies, gold drops, people panic, dollar fades, gold goes higher, repeat for half a century. Now, let me talk about gold. And I am going to tell you something about the crash that you will not hear on any other channel because everyone is focused on how far gold fell. Nobody's looking at how fast it bounced. And that bounce tells you everything. Gold was at 4,400 at the bottom of this crash. It has already bounced back to around 4,900. The shape it is making on the chart, without getting into technical jargon, looks like a coiled spring. It is compressing between a floor that keeps rising and a ceiling. These patterns typically resolve with a big move, and the math behind the pattern points to roughly 5,900 as a target. That also happens to line up with JP Morgan's year-end forecast of 6,300. Could it go lower first? Absolutely. If it does, I'm watching 4,500 as my buy zone. That is where the heaviest buying kicked in during this crash. Sovereign money, central banks, the kind of buyers who do not check their phone every 5 minutes, they were buying between 4,400 and 4,600. If gold comes back to that area, I think it is a gift. But here's what I find interesting. Gold hit 4,400 during the crash and bounced hard. It did not sit there. It did not slowly drift down to 4,000 or 3,500. It touched 4,400, and within days, it was back above 4,900. That kind of bounce does not happen unless serious money is waiting at that level. Someone wanted that gold, and they took it fast. That tells me 4,400 to 4,600 is real support, not theoretical, proven. And I want to be clear, if gold breaks below 4,400 and stays there, the picture changes. That would concern me. I'm not married to any position. I'm watching the levels and reacting to what the market does, not what I want it to do. Blind loyalty to a position is how people lose money. I would rather be wrong and protect my capital than be stubborn and watch it disappear. That is just how I think about this. But here's my bigger picture view on gold. And I want to be upfront that this is my personal opinion. I think gold is going to $6,500 to $7,000. Not tomorrow, not next month. But in this cycle, the structural forces pushing gold higher, the central bank buying the dollar debasement, the deficit, the geopolitical chaos, none of these are going away. They are getting stronger. And if JP Morgan is calling for 6,300 by year end, and the chart pattern is pointing to 5,900 as a near-term target, then 6,500 to 7,000 over the next 12 to 24 months is not a fantasy. It is the logical extension of everything that is already happening. But, and this is the part most people get wrong, your entry price matters enormously. Buying gold at 5,500 and writing it to 7,000 is a 27% gain. Not bad, but buying gold at 4,500 and writing it to 7,000 is a 55% gain. Same destination, completely different outcome. That is why I keep saying, wait for the pullback. The thesis can be right, and you can still lose money if you chase the price higher. Accumulating at the right levels, 4,000 to 4,500, that is how you actually build wealth in a bull market. Not by buying the rips, by buying the dips. And right now we are in a dip. Silver. This one is personal for me because silver is my largest metal holding, and watching it go from 121 to 75 was not fun. Even though I believe in the long-term thesis, a 40% drop is a 40% drop. It tests your conviction. It makes you question everything. It makes you lie awake at night thinking about whether you should have sold at 100 or at 90 or at 80. I get it. I have been there. I am there. But here's what I noticed during the crash that made me stop and think. The paper price of silver, the one you see on your screen, collapsed. But the physical market told a different story. Lease rates in London, which measure how badly people want to borrow actual physical silver, shot up to 5%. That is extreme. That is stress. That means people with real money needed real metal even while the price was crashing. Comics deliveries in the first 6 days of February were 22.5 million ounces. People were not selling physical silver during the crash. They were buying it, standing in line for delivery. There's a disconnect right now between what the paper market is saying and what the physical market is saying. Paper says sell. Physical says hold everything and give me more. And by the way, during the crash, the iShares Silver ETF SLV had over $40 billion in trading volume in a single day. 40 billion. That is more trading volume than Apple and Amazon combined. Silver, a metal that most people think of as something their grandmother collected, was traded more heavily than the two biggest companies on earth. That does not happen in a market that is dying. That happens in a market that is being fought over. One of them is wrong, the paper price or the physical demand. And historically, when there's a gap this wide, the physical market wins, not always quickly. It taps it, confirms it as new support, and then launches higher. That is textbook. And if silver retests $50 to $60 and holds, which I believe it will, that confirms the breakout. And what comes after a confirmed 50-year breakout is not a move back to 80 or 90. It is a move to 130, 150, possibly higher. Because once a ceiling that held for 50 years becomes a floor, the market reprices everything above it. That is why my buy zone is 60. Not because I think silver is going to collapse, but because a retest of the breakout zone would be the single best entry point for the next leg up. And if it does not come back to 60, if 75 is the low, then the breakout is even stronger than I think. Either way, the 50-year ceiling is gone. And what that means for the next few years is something most people have not even begun to process. And there is something else happening with silver that most people do not know about. There are reports that the Chinese government may be directly intervening in a massive silver short position. A trader named Bianiming was short silver in size, and the CCP may be stepping in. If a national government is managing silver positions, that tells you this metal has become geopolitical. It is not just a commodity anymore. Nations are treating it like a strategic resource. And you are being told it is worthless and you should sell it. The geopolitical situation right now is only making this worse. Or better, depending on which side of this trade you are on. Taiwan just told the United States that its demand to move 40% of chip manufacturing to America is, and I'm quoting the headline, impossible. If the US pushes harder, tariffs Taiwanese chips, there's a real scenario where Taiwan starts considering closer ties with China. That kind of geopolitical shift sends gold up hundreds of dollars overnight. Cuba has reached a point where public buses have stopped running. The government cannot maintain basic services. That is what currency collapse looks like in real life. I'm not comparing the US to Cuba, but the forces that destroyed their currency, deficit spending, money printing, loss of confidence, those same forces exist everywhere right now. The difference is degree, and gold is insurance against the degree getting worse. Every geopolitical headline right now points in one direction. Higher gold, not lower. Let me talk about mining stocks, because I know a lot of you own them. And I know the last few weeks have been brutal. If you bought a junior miner near the top, you might be down 40 or 50%. That is gut-wrenching. And I'm not going to tell you to just hold and be patient, because that is easy to say when it is not your money. But I need to show you something. And I debated whether to include this in the video because it is the kind of thing most finance channels never show. It is a long-term chart of gold mining stocks compared to gold itself going back to 2007, almost 20 years. Here's what you see. Mining stocks went down relative to gold for over a decade, crashed, hit rock bottom around 2015 to 2020, the worst period to own mining stocks in a generation, absolute despair. And then slowly, quietly, they started curving back up, the shape they are making, and I'm going to describe it simply. Looks like a giant U. A decade of pain on the left side, a bottom in the middle, and a rise on the right that is just starting. That U-shape historically, when it completes, leads to years of miners outperforming gold. Not weeks, years. And the junior miners, the smaller exploration and development companies, just did something on the weekly chart that they have not done in over a decade. They broke above a resistance level that has capped them since 2013 on massive volume. That is the kind of breakout that technical analysts wait their entire career to see. Does this mean juniors are a guaranteed win? No. Mining stocks are volatile. They can drop 30% in a week. They are not for your emergency fund. They are not for money you need in 6 months. I want to be very clear about that. But if you have a long time horizon and you understand the risk, the setup in miners right now is rare. The big producers have a realistic path to being 40 to 50% higher from here. And the juniors, if history is any guide, could do multiples of that. Now, before I wrap this up, I need to address the elephant in the room. The title of this video, they want you to sell. Who is they? It is not a secret cabal. It is not a shadowy group in a dark room. It is simpler than that. It is the structure of the market itself. When you sell physical gold or silver during a crash, that metal does not disappear. Someone buys it. And the people buying during crashes are never retail investors. They are institutions. They are central banks. They are sovereign wealth funds. They are the biggest, most patient, most well-funded buyers on the planet. And they need sellers. They need panic. They need you to feel like the world is ending. So you hand them your metal at a discount. The margin hikes are part of it. When the exchange raises margin requirements during a crash, it forces leveraged traders to sell. More selling creates more panic. More panic creates more selling. It is a cascade designed to flush out anyone who cannot hold and who is left standing at the end. The people with the deepest pockets and the longest time horizons. They buy what you sold and they profit from the recovery you missed. Your panic is their portfolio. I'm not blaming you if you sold. Fear is the most powerful force in financial markets. More powerful than greed. More powerful than logic. But the data is clear. The people who sell crashes underperform the people who hold through them. Every time. The deficit situation in the United States is not fixable. Not under this administration, not under the next one. The government is spending at crisis levels during the best economic conditions we are likely to see for years. If they cannot cut spending now, they never will. And every year they do not. The dollar loses more value and gold becomes more necessary. This is not a cycle that ends. It is a staircase going down, just like that 50-year chart I showed you earlier. What I am going to tell you is that the reasons I own precious metals have not changed because of this crash. Not one of them. China is still buying. The dollar is still dying. The deficit is still unfixable. The physical market is still tight. Nothing fundamental has changed. The only thing that changed is the price. And if the thesis is the same, but the price is lower, that is not a disaster. That is a sale. But you have to make that call for yourself. If you decide the risk is too high, I respect that. Protecting your mental health is more important than any trade. But do not sell because a headline scared you. Do not sell because a pundit who does not own a single ounce told you the rally is over. Do not let fear make the decision. I titled this video, "They Want You to Sell." So ask yourself this. If the bull market was truly over, why is China still buying? Why are comics deliveries surging? Why is the dollar still dying? Why is every geopolitical crisis getting worse? If it was over, at least one of those would have changed. None have. Every crash in this bull market has been followed by higher highs. Whether it happens again, I do not know. But the setup is here. The data is clear, and the choice is yours. If this helped you think more clearly, like the video, share it with someone who is scared right now. Because the worst financial decisions happen when people are alone with their fear and no data to counter it. Drop your thoughts in the comments. Tell me what you're doing. I read every single one. This is the hidden economy. I will see you in the next